Hi, thank you for tuning in. Welcome to the It's Your Money and It's Your Estate workshop series brought to you by our nonprofit organization, Financial and Estate Literacy. Our mission is to empower people like you to take control of their finances, their estate, and charitable giving decisions. For the past 25 years, our founder, Peter Kote, and our entire team have been providing these free, unbiased, and accessible 6 weeks programs all over Orange County, California to help you make informed choices that align with your unique needs and values. Now let's take a quick look at our website, iyme.org. On our homepage, you can easily view our schedule, which has all the information for these webinars, as well as the in-person workshops. You can also register for these webinars straight from the homepage. Now, if you click workshops and select the series of your choice, you'll find the topics for each of the weeks of the program. Each of those pages will have the recording of the webinar, which is usually posted about 3 to 4 days after the live webinar airs. Underneath that, you'll find the general workshop documents, which are our workbooks, which will guide you through the series, our booklets, as well as the very important Ask First form, which is very useful anytime you want to retain someone's services. Depending on the location where you take our classes or whether it's an online webinar, you'll find the speaker's presentation as well as their signed Ask First form. If you scroll all the way to the bottom, you'll find a selection of updated articles curated by Peter Kote, which are relevant to the topic of the day. Lastly, I want to go to our sponsor page, because without the support of our charitable sponsors, this program would not be possible. Now, let's start the program. This webinar is the first session of the It's Your Money 6-week program. The topic for today is overview and tax changes. And our guest speaker is Mark Prendergast. Enjoy the workshop.
Mark, come online. And there is Mark.
There we go.
Hey, good morning.
Pete, good morning.
Let's introduce you and using your Ask First form. And we'll explain a little bit of what an Ask First form is, but talk a little bit about what you do and how you do it, and give me us a little bit of background on you personally, because you're pretty awesome.
Well, I don't know about that, but I work for a company called Appella Wealth. My wife and I are part owners in it, and we are what people call comprehensive financial planners. And I almost don't like the word comprehensive. It just sounds kind of boring, or everybody says it, but it's true. We when we look at financial planning, and we'll look at like what we cover, and Pete went over that a little bit, but we look at your insurances. We don't sell insurance, but we look and make sure the insurances are properly in place. We call it risk management. We manage investments. We do tax planning. We do estate planning. And as you tie a lot of that together, it comes into retirement planning. Am I going to have enough money? Is it going to be protected for the rest of my life? And
number one concern for people is, am I going to be running out of money?
Right.
Yeah. So is there a rule that you can only call yourself a financial planner if you have a certain degree or education level?
No, unfortunately, anybody can call themselves a financial planner, and you need no experience. And I think there have been cases where there have been national ads that say, become a financial planner, no experience required.
So what we recommend highly when you talk to anyone about your money is that you do what's called, or complete what's called, our Ask First form. So could you put yours up, Mark, on the screen?
Okay, let me go find that. Share screen. There's mine.
We have a blank Ask First form on our website, and it's right above. And we suggest highly that before you start doing business with anyone about your money, these kind of are the questions to ask. So the first thing is that your education, Mark, what you mark on here, you got a master's or other advanced degree. Where'd you get your education?
My undergrad is from Fresno State, one of the state universities, much like Cal State Long Beach, Cal State Fullerton, et cetera. Undergrad, so that was in accounting, and then I got a master's degree from the College for Financial Planning out of Denver, master's in advanced financial planning.
Wow. So that's a great background. Now, if somebody were to get hired by a Merrill Lynch or a Morgan Stanley, would they have to have a master's degree or a college education?
They certainly don't have to have a master's degree. Whether they have to have a college education, I'm not sure. I don't think they do. They just have to pass a series of sales exams is what they have to do.
Yeah, exactly. So, so education is pretty important. A lot of people are confused between a credential and a license. A credential is something that you really have to earn, and like a CPA, you are a certified public accountant. Do you practice as a CPA or do you practice as a financial planner?
Well, I practice kind of as both, because when I do tax planning and estate planning, I'm relying much more on my CPA skills, especially on the income tax side. And what I do within our firm, I do three things within our firm. We have other people that do general financial planning. I do only tax planning, estate planning, and unfortunately, I'll say divorce planning. Those are the three things I do. So they bring me in as a specialist, and I'll help with clients on issues. I'll help the other senior financial planners, and then I'll back out and go on to other projects.
Okay. And then, so a CPA, you just can't do overnight. You've earned that. And it's a pretty extensive exam. The CFP, what does that stand for? And what did you have to do to earn that?
So yeah, CFP stands for Certified Financial Planner. And in order to attain that designation, first of all, you have to have a college degree, a 4-year degree. And then we go through what they call the 4 E's, and I'm on the spot here if I can remember all of them, but you have to have a certain, there's an educational component where there are 6 or 7 specific courses on investments and insurance and taxes, estate, et cetera. So the education, you have to pass that. You have to have experience, at least 2 years working underneath a certified financial planner, or 3 years. Maybe you don't have to be totally underneath a certified financial planner.
And then you have to have your continuing education.
Continue education, 30 hours every 2 years.
But generally, there's about, I would say, maybe 60, 70,000 CFPs in the country. But is that becoming, or is it the designation to have for a financial advisor, financial planner?
It is. It's the most widely recognized and I'll say honored, whether it should be or not. Some people have it just as the sales initials behind their name. They really aren't financial planners, but you have CFP behind your name. But it's
kind of the designation to have for a beginning.
Right. It is the base level. And I believe there's over 100,000 now.
Really?
I believe so.
So, but it's still a small minority of individuals who are in the financial services industry.
Correct. It is. Vast majority.
Yeah. You got 40 years experience. You don't look that old.
I am.
Where's that gray hair? But because experience is really important, isn't it, in this area?
Experience and training is really, really important. Absolutely.
Yeah, it's just when I was at Long Beach State University, I asked the professors and staff, why did you hire the financial advisor that you do have? And the only thing they could come up with is that the person is really, really nice. And, you know, it's not enough. You got to understand the education and credentials. What is the difference between a credential and a license?
Well, I'll call it in the investment world, a license is generally a license to be able to sell a product.
It's like a driver's license, a minimum
I get
qualification.
correct, right? And hopefully, I mean, so that somebody overlooks them, so they are not damaging people.
Yeah.
In theory.
So your license you have a CPA license issued by California. You got a license number there. Why is that important? I mean, for a consumer.
Well, they don't need necessarily to have my license, but it's good to have that. It helps them search me out if they want to. They can go on the state of California and look up CPAs and see if I have any what's called a disclosure item, which means if I've done either done something bad or been accused of something bad, then
it'll be there.
That will be disclosed, correct?
Yeah, and same thing with the CFP. There's a license number. Check people out. It was recently in Laguna Beach. There was a businessman who was just admitted that he committed $6 million in fraud, and he held himself out as an accountant, a tax person, and as a financial advisor and an estate planner. And he had disclosures, and all somebody would have had to do was look him up, and they would have never done business with him. So we got to look people up who we hire. Divorce planning, is that, talk a little bit about why that is a necessary area to be practicing in. Or,
well, it's you know, unfortunately, it's a traumatic financial transaction that happens as you're splitting up marital assets, and the type of asset a person receives out of the divorce creates a future financial trajectory. If a person has and there are tax consequences. If a person has a brokerage account or a savings account of $1 million, or they have an IRA of $1 million, if I'm going to advise the client, I'm going to say, I want the brokerage or the savings account because there's no future taxes. It's after-tax dollars. The IRA at $1 million, if you liquidate it, it might be worth, you know, $600,000, $700,000 because you have to pay taxes on it. That's just the most simple example. But so we're trying to find what that asset is and then look into the future. How is it going to benefit that person? Is a house a better thing to have? Are more financial assets better to have? There's no right or wrong answer other than diving into those.
Yeah, and I want to expand that a little bit. So if somebody's looking for a financial advisor, one of the important things besides just the credentials and the license is the rapport, the trust. And one of the things that you should ask your financial advisor is, what kind of clients do you have? What are you familiar with? You know, so if Mark's clientele, I would imagine many of your clients are women.
They are. We have a market focus that we call women in transition, which would be divorcees and widows, women executives retiring, women inheriting money. That's our market focus for our firm here in Huntington Beach.
Yeah. So you don't practice law, but you do review people's estate plans as a financial advisor.
Correct. We look at all of their estate documents and look to see how old they are, what the provisions are, mostly the testamentary, what happens when I die, when the first spouse dies and the second spouse dies, what happens, and then ask, is that really what you want? Because a lot of times they go, I really don't know what's in there. Attorney prepared it, and they need to know because it's your money.
Yeah, exactly. And your estate.
And your estate.
If you scroll down a little bit more, we're going to be talking about this to ad nauseum. throughout the 6 weeks. But let's start on it now. It says here, our business relationship, check true or false. And you check true. And you say, I will at all times serve as a fiduciary and put your interest before my interest and those of my employer. Shouldn't everybody be that way?
Everybody should be. Yes, they should.
But in the financial services industry, I would say 95% of people in the financial services industry would have to put false in that on that question.
They should put false on there. I'm not sure what they would put.
Yeah, but you put true. What does fiduciary mean to you, or legally, what does it mean?
First and foremost, it means I have to put the client's interest before I put my own. And the second is, if I have conflicts of interest, I need to disclose those conflicts. And there are times when we have, we like to think that fee-only people don't have conflicts, but we all have conflicts. I mean, if a person inherits $500,000 and they say, oh, I want to pay my mortgage off, or should I give it to you to invest? I could go, well, if you give it to us, we have more assets under management, I make more money. There's a conflict that I have, and I should disclose that to the client to say, if I tell you to bring it here, that might be a conflict. If I tell you to pay the mortgage off, I'm not going to be earning that money. But my goal is to find what is the best solution for you. If you have a 2.5% mortgage, I might go, you can't get a 2.5% mortgage. You should not pay that off. You can earn more with it. So I have to balance those and disclose that.
Yeah. Yeah. And we'll talk more about fiduciary because it's literally one of the most important issues on this. Another one of the top issues is, how are you compensated? So if you sell a mutual fund, you get a piece of the action.
We do not get any commissions for selling anything. We don't sell anything, and I'm not licensed to sell anything. To be licensed to sell, there's regulation over people because there's bad incentive. So the only person that pays us is the client. We don't have a mutual fund, doesn't kick in any money. Insurance company doesn't give us any money. If we refer to an insurance person to buy long-term care or homeowners, we don't get any kickbacks or commission shares. We're not licensed to receive commission, so only the client pays us. And that's one of the ways we put their interest first, because I can buy and sell, we'll say, securities till we're blue in the face, and I'm not going to earn any extra money. So I'll stop there.
Okay. And then are you associated with anyone who sells and you get kickbacks on annuities, insurance, or mutual funds?
No, not at all.
And you do review somebody's, one of the first things I think you probably do is review someone's insurance because you don't want them to lose what they have.
Absolutely.
Okay.
And actually, when we first engage them, we do, like a doctor would do, triage. You say, what are your pain points? And that's what we want to address first. Oftentimes it's estate planning is the first pain point, but a lot of times it's to make sure that the protections are in order, as you say.
Yeah. And by the way, then you certify that the above is true and correct. If anything on here is untrue and you end up going to court, this document right here is worth the time. By the way, how long did it take you to complete this?
Probably 10 or 15 minutes, maybe.
Was there anything offensive about it?
No.
Okay.
It was very straightforward.
Yeah. Yeah. This is kind of the minimum that you should know about the person that you have hired to help you with your financial matters. If you have hired somebody and you don't know any of these questions, the answers to these questions, there's a blank copy on our website and right above our program, and ask them to complete it. Say you're in a class and they want all of our financial advisors to complete it. This is the minimum. We're going to go into a little bit more about the kind of the animals in the zoo of the financial services industry, because there's a lot of them. But let's go to your outline, Mark, and let's get started.
Okay. Well, it'll take me a little bit, I think, to navigate this. I'm not the pro that Eugene is over there.
We call him our wizard.
Okay. I want to go to there, I think, and then does that show me in hiking right now? Is that where we are?
We still have your Ask First form on the screen.
Okay. Okay.
And I think you should just click your outline.
Okay.
Ta-da, there it is.
And let's see. Now it's when I think I want to get to my other screen. Let me stop sharing and let me share a different screen. See if I can do that.
All righty. Yeah, we're not experts at this, and we don't do this on a daily basis.
There.
Aha! There we go. Perfect.
Okay.
And by the way, Mark is also a national award winner. So I want to congratulate you.
Thank you. Yeah.
All right, let's get into the program.
Okay. I'm trying to, unfortunately, my face is right over part of the, oh, there we go. I got to move it. There we go. Okay. It's Your Money. This is week one. It's an overview. We're talking about tax changes, the overview of the entire program, and then we'll also talk about some potential tax law changes. There's my name, my contact information. If you ever have a question, you maybe put "It's Your Money" in the subject line, because I get a lot of spam, so I just delete a lot of stuff I don't recognize. Plus, we have a pretty strong spam filter, so it goes into a special box. But if you have a question, you're free to email me. I think Pete covered a lot of this. This is what the 6 weeks are. I'm going to emphasize there week 6. You know, it's a building block process, and that week 6 really is a very rich program where it's almost like a case study, and you could imagine yourself in the shoes of that client that's going through that. So it's
brings it all together.
It brings it all together, and that's what a real financial. You're going to find components of what financial planners do through weeks 1 through 5. Week 6 says this is what a financial planner, a quality one, really does. So encourage you to stick it through the whole process. Today's topics, we're going to talk some about regulation of the investment industry. We're going to talk about the financial planning process, and then for taxes, some stuff that's new for 2024, and then maybe some tried and true basics. We might not get through everything, and if we don't, that's not going to bother me. I hope it doesn't bother you. We're just going to try to give you rich content all the way up till 11:30.
We may cut out a little bit of the financial planning process so that we can get to the tax issues.
Yeah. So financial planners, advisors, and salespersons. So Pete, mentioned this, that anybody can call themselves a financial planner or a financial advisor, and a lot of them are truly salespersons and not necessarily planners. So we have two main regulators, and this is not in financial planning, but this is really in the investment world. Two main ones. One is a Securities Exchange Commission. The other is what we call FINRA. And FINRA, I'll focus on them first. It's a self-regulatory body. So people like Merrill Lynch, Wells Fargo Advisors, LPL, there's a lot that they all get together, and they're trying to regulate and police themselves and their own people. It's a membership organization, and their purpose is to regulate sales activities, not to give planning or advice. That's not what FINRA does. They're just trying to make sure that the sales activity is somewhat ethical, I'll say.
Reasonable.
Reasonable, and they're
suitable is the
suitable.
word.
I was looking for the word.
Suitable is the word that they use.
Correct. They're looking for suitability, that something that's sold to you is suitable for you. And there may be three products that a person could sell to you. One could give you a 4% commission, one a 5% commission, one an 8% commission. And all they have to do is justify whichever one they think is right, that is suitable for you. It doesn't have to be the best one. And I'll say that's the difference between a fee-only financial planner with the fiduciary model is we have to, the highest commission one might be the best one if that were the case and we were recommending, but we usually don't recommend commission products. But that's what we're looking for is the best. They have this inherent conflict of interest. So when somebody has, like on that Ask First form, if you see Series 6 and Series 7 licenses on there with some numbers, that should tell you that they're licensed to sell a product, not to give advice. It's to sell a product.
We don't have any presenters in our program, in person or online, that has a Series 6 or 7 license.
And my
Or
guess
that
is,
has an insurance license.
right.
We're trying to create a safe environment for you to learn about your money. And if somebody's trying to sell you something and they say it's educational, I think that's a conflict.
Yeah, especially if a steak dinner's involved. But and so when you, if you, those in the audience, if you use that Ask First form and give it to your advisor, and you see those Series 6 or Series 7 licenses where it asks about the licenses, that just, at least it informs you that they are authorized to sell products and they're regulated that way.
And that doesn't mean they're unethical. It just means that they're a salesperson.
Correct. And then I'll go back to the top part. The Securities and Exchange Commission, they, the Registered Investment Advisor, RIA, is the firm. So our firm is Appella Wealth, and that is the Registered Investment Advisor. And down below that are the individuals in the firm. So myself, my wife, we're in the same firm, and we have 5 other planners. They're all individual advisor representatives, IAR. So it's got, the acronym is so close, RIA and IAR. And to tell you the truth, even between the two of them, as I'm speaking to you, it's probably pretty muddy. You know, Securities Exchange Commission, Financial Industry Regulatory Authority, it all sounds the same, but the fee-only world is up, they're regulated by the SEC, or they might be regulated by the state of California if they're an RIA and they're under a certain threshold. If they manage like less than $100 million, then to be regulated by the state of California, or above that, it's a Securities Exchange Commission. So that's what you're looking for in the fee-only world, is that they're an RIA. Some people can be an RIA or an IAR. They can be both. They call them duly registered. The problem with that is that we call it hat switching. They can be managing your money for a fee. Oh, I'm only charging you. Oh, nobody's giving me, mutual funds are not giving me, but oh, I want to sell you an annuity. I'm going to take off my fiduciary hat. I'm going to put my sales hat on, and then I might sell you an annuity. And I'm never going to tell you, hey, I'm changing hats right now, just so you know. It's just going to be part of the conversation. Oh, I think, well, you need safety, so I'm going to sell you an annuity. So it's just, it's a murky world.
I think of it as like, you know, if you go and, hey, I want to buy a car, you're going to go to the Mercedes-Benz dealership, and, you know, you're going to be talking to a car salesperson. The difference would be is that if you were to hire a mechanic or someone outside of being a car salesman to advise you and what is the best car for you. And they will go into, well, how do you drive, and how many miles do you put on there, and what's most important to you? It's a whole different conversation. And I find the financial services world to be the same thing. Well, we're going to go into financial planning 1 as our first topic, which is completely different. And we don't get into really the investment part until week 5. So it's we got to find out a little bit about you, but how we're regulated is absolutely important. And you got to understand whether or not who you're talking to.
Which brings up compensation models and how the planners and salespeople are compensated. How do I earn money? And so here are the compensation models. Some people earn purely commission. Some people are fee and commission. That means, I talked about a little bit of hat switching there. Oh, I manage only for a fee, but I can also get commissions on certain products. And you really don't know what products are getting a commission on and what they're not. Something called a fee offset, where they would say, oh, I'm charging you a fee. If there's a commission over on this product here, I'm going to reduce my fee so you aren't paying the commission or you don't feel like you are. Some people call themselves fee-based, and that is just probably the most misleading of all of them. At least commission, fee and commission, fee offset, you know exactly what that means. Fee-based sounds like fee only, and that's what the person wants you to think they are, is fee only. And the fee only is the pure fiduciary model, which means you are the only person that's paying me, no other firm, no other.
Therefore, the legal obligations, the work, everything is related to you because you're the one that's paying them. Follow the money.
Follow the money. So credentials. There's lots of different ones. We talked about being a registered investment advisor, or the person underneath it being the IAR. If a person is a registered rep, that's under FINRA, and that's for sales. That's the Series 6 and Series 7 licenses. We talked about the certified financial planner and what that means. There's something called a chartered financial analyst. They call them a CFA charter holder. That's a very high and well-respected degree in investments. It's focused on investments, not on financial planning, purely on investments. But if you see a person that's a CFP and a CFA, much like I like to think, if somebody sees CFP and a CPA, they go, oh, they have a little bit more chops to them. And so, CFA is very, very highly reputed. And there are so many other ones. I tell you, if I can, I'm going to try to find the FINRA screen that shows you all of them.
You're doing that, when you're in sales, there are so many courses that are out there that make you a better salesperson. And what they've found out essentially is that in the financial planning world or the financial services world, the more designations that you have behind your name, people are more apt to believe you as to what you're trying to sell. And so there are so many designations in the financial services industry that you can basically buy. And people don't check what these designations mean. And so FINRA has put together a list of these designations, and most of them are purchased. They're worthless, and they don't mean that you earned them. You paid for them. So if you don't understand a designation behind someone's name, please Google it so that you can find out. And they try to make it sound like they really earn this stuff. But usually, if you look at through the fine print, it's basically a purchase designation.
Right. And this is on the FINRA website and on the PowerPoint, which you can download. You can see the website, but I'm just going to scroll through here. How many accredited people there are? Wait till you see certified. It's like, oh my gosh, we have certified.
Are you sharing your screen?
I think I am. Can you see?
No,
it?
You're not. Not yet.
Oh, sorry about that. It says I'm sharing.
Okay.
It says I'm sharing my screen.
At least I don't see it on my screen.
Okay, let me move it over to here. How about there?
Yeah. No, not yet. Still on your outline.
Oh, let me.
I don't see the outline. I do see the credentials.
Oh, you did. Oh, okay.
Yeah.
Okay.
Pete, I'm not sure.
Oh, not that one.
Well, anyway, Mark, they got the website. Yeah. Oh, there you go.
There you go.
Got it. At least it's on my screen.
Okay. So you can see how many certifieds there are from certified annuity advisor. That'd be an interesting, but you just certified everything. They have certified these divorce ones I saw. Like I see 4 of them, like 1, 2, 3, 4, 5, 6 of them. And I'm not sure what all of them are, except this one here, certified divorce financial analyst. I know what that one is, but over here, it lets you look at details too. So this would be a good thing to go look at. And the details, whoever did this is going to try to sell you in this too. So, but you look at the details, and that'll be a good starting point, and then Google it and find out more information about it.
Yeah.
So
excellent suggestion.
we'll see if I can efficiently get back to my presentation.
You have to be a kind of a Zoom guru to do this. Aha! We're
Are we
back.
there? Okay, we're
We
back.
are. Let's go to the next slide.
Okay. So we talked about the ask first, use that ask first form and find out all the information. And you are trying to find out, are they truly a fiduciary and how do they get paid? I mean, the two of them go together.
Yeah, the only one that in the additional one is FINRA, and the way to get to FINRA is by going Google broker check. Everything in the financial industry is about full disclosure, prospectus, ADV form. If I give you all the information about myself and the investment, then you as a reasonable individual can figure it out. Well, it's a little bit more difficult than that. But FINRA operates a site that gives full disclosure to everyone, and it's called broker check. So if somebody says they're in the financial services industry, they should be listed on FINRA. So Google broker check, put their name in, and then you'll have full disclosure. And we'll go more into detail when we get to the FINRA part. Let's go on.
Okay.
The process.
Here is the financial planning process, and you would see that in week 6, you see this in kind of full-blown scale. But first, you want to understand their personal and financial circumstances, and then we need to talk about their values and how that fits into their goals. What are their goals? Do they want to, number one is always, I don't want to run out of money, but also young families want to save for their kids' college education. They may want to have a vacation home and up at Arrowhead, find out what their goals are. Then we analyze a current course of action and potential alternatives. There's a lot of different ways to get there, and then we'll come up with some financial planning recommendations. We present the plan to the client, and then we implement the plan. Implementing that plan, part of it is, well, how many stocks, how many bonds, what's your balance there between stocks and bonds? But other parts are, get your estate plan in order, because if something happens to one of you, what's going to happen to the spouse, what's going to happen to the kids? Then there's risk management. That's part of implementing the plan, making sure insurances are appropriate, because if there's not enough to pay for the kids' education and the primary earner's gone, that's a problem. So we're not anti-insurance in any way, shape, or form. We want the right insurance. So implementing the plan with the right products, and then monitor and update and adjust the plan. So we meet with clients at a minimum. We try to meet every year. A lot of times clients are resistant. No, everything's okay. But our attempt is at least once a year. Some clients like to come in once a quarter, just chat about what's going on. And it's good if we know what's going on in their lives. We may pick up something that they don't realize is just an item for our attention.
And your first point, you're understanding client's personal and financial circumstance. That process doesn't happen in the first day, does it? Or what do you do to find out their financial circumstance?
Well, what we do is the foundation. Is there not,
I think it's on the next slide.
Yeah, let's see.
Well, okay. Well, this is part of it. Yeah. You look at your tax return.
But I can give you an example of what we do on the first meeting, which is the foundation. We don't learn all of it on the first meeting, but our first meeting, called a discovery meeting, the first thing we're going to do is we're going to find out what their values are. What does money mean to you? Why is it important to you? What are your first memories of money? And then we're going to go from the values, try to figure out what are their goals, and elicit that out and they may not know them. And so we'll have kind of open-ended questions and let them talk to get them know them better. And then we're going to find out about their family relationships, if they have to support parents, the ages of the kids, everybody's birthday, if they have any other people that are important to them in their lives. They may have a niece that's a favorite niece that they want to help, or special needs, somebody in their family. The family relationships, then we're going to find out about their other professional advisors. And then we're going to talk about, we've learned about kind of what they're looking for and kind of get a feel for what their needs are. Then we, after all of that, we look at what resources do you bring to bear. Those resources could be current investments, current savings, but it's also working their I want to call it their working capital. I'm not sure the right term, but you know, their ability to earn a living, and how can they fund these goals through their wages, you know, and earnings.
Through retirement up until their death, you know?
Right.
You know, the biggest concern people have is, you know, running out of money. And, you know, a good financial planner is one that can crunch numbers. You know, it's not about being nice. It's about crunching those numbers and getting to know you and what risks are you willing to take to get the return that you may need, or how much are you spending on an annual basis? You know, are you supporting a parent, or are you supporting a grandchild? You know, we all have family financial issues, and it's up to the financial advisor to uncover them and help you and assist you. But one of the biggest things is taxes. Let's talk about taxes.
Let's do that. Okay. Taxes matter. So we're shifting from general financial planning and just narrowing down into taxes matter and things that you should be thinking about. And where do taxes matter? Tax brackets matter. We're going to talk about that in a little bit. The timing of taxable income matters. If you have a capital gain in December, or if you say, wait a second, I know it's going to be a big capital gain, maybe I can do that in December, sell that stock in December, I can push it off and I have more time to plan the following year. Ordinary income versus capital gain. Ordinary income is at higher rates, up to 37% right now. Capital gain rates might be as low as 0 on the federal side, or as high as 20%. Your adjusted gross income matters. The higher your adjusted gross income, if you're of Medicare age like Pete and I are, and if your AGI is higher, you're going to have to pay more in Medicare premiums. There's a base level that everybody pays, but the more you make over certain thresholds. So we want to, that's part of tax planning, is monitoring and trying to adjust our adjusted gross income. Maximizing charitable giving strategies. There's a lot of different strategies around that. Rather than just writing a check, there are some things that are much, much more efficient. And then the power of step up in basis, and that is when a person dies, the person who inherits that asset, it's as if they bought that asset on the date of their, I'll call it their parents' death, so that they could turn around, let's say it's a family home, and let's say the parents bought it at $100,000 and now it's worth $1.2 million. The kids can now sell that $1.2 million and pay 0 capital gains. Whereas if mom would have sold it 3 months before she died, she'd have had to pay capital gains. So
if your financial advisor has not looked at your tax situation, you don't have an advisor. You know,
yeah.
You need to know, if you're doing it yourself, this is the chart you really need to know. What income tax bracket are you in? Just on the fact of how much should you withdraw from your IRA on an annual basis is based on, I would say, your income tax bracket.
That's exactly right. And so this is for married filing jointly. There's no use me putting up all sorts of different schedules, right? But this is a good illustration here, and that is, if your taxable income is $0 to $23,000, your tax rate is 10%. So as we go down to the next bracket, we see if the baseline at 23.2, there's the 10%. The tax is $2,320 plus 12% of anything over $23,200. If you're in at 10% and you bring in some extra money and you move to 12%, as a tax planner, I'm not all that concerned. 10 or 12, very, very close. But all of a sudden, your taxable income goes above $94,000, that next tier between 94,000 and 201, now I'm at 22%. I went from 12 up to 22. That's a 10%. It almost doubles your tax rate. It's not on everything. You still get the benefit of the 10, the benefit of the 12, but every extra dollar is now going to be very, very much more expensive compared to the earlier dollars. And again, I'm just going to kind of walk down this tax rate schedule. You know, we go from 22%. If I'm sometimes you're just in a rate and you're going to be in that rate most of your life. And if I move from a 22 to a 24, again, I'm just not that concerned between 2 percentage points. But here I am, if I'm at 383 of my taxable income and I'm going above that, now I've jumped 8%, not these little 2% things, then I've gone 8%. So I'm going to try to keep myself in that 24% bracket. Again, let's say I have I want to buy a car and I need to pull money out of my IRA. Well, it's going to be at this tax rate here. And if that pushes me into the 32% bracket, if I'm in October, November, December, I might say, listen, I'll make that IRA withdrawal in January. Maybe that's when I'm going to pay. Maybe I'll finance the car for 3 months. They offer me, some good finance rate, even if it's not a super great finance rate. I might want to finance the car for 3 months and then go pay it off by taking a distribution in January, and then I can adjust my IRA distributions for the following year. So that's why tax rates matter. It's not just this even progression, especially these two, going from 12 to 22 or going from 24 to 32. Those are the big gaps of a 10% jump or an 8% jump. And here are the capital gain rates, and qualified dividends also are taxed at long-term capital gain rates. People might wonder, what is a qualified dividend? And I'll try to give a brief description of that. That's just a dividend that comes from a stock, basically. So Chevron, IBM, Apple, when they issue a dividend, that's called a qualified dividend. A non-qualified dividend usually comes from a bond. It's in a mutual fund. The mutual fund owns a bunch of bonds, and the bonds pay interest. And so the interest, when it's distributed from a mutual fund, it's called a non-qualified dividend, because interest income does not get favorable rates, but stock dividends do. So stock dividends plus your long-term capital gains. For a married couple here, if your taxable income is under $94,000, your long-term capital gain rate is 0. So in this example, I might say your normal taxable income is at $80,000. I can bring another $14,000 of capital gains in and pay 0 taxes on it. So that might give me an incentive to say, why don't I sell some and pay 0 capital gain tax, and then I can rebuy that same stock, and now I have a higher tax basis, and I might lower my future taxes. So
Mark, is annuity income a capital gain, or is that ordinary?
It's a great question, because it feels like investment income of sorts, but it is an annuity income is taxed as ordinary income. So at the higher rates, that's one of the negatives to investing in an annuity, is the fact that when you want to pull money out, all the earnings are taxed at ordinary rates. You will not get this 0%, 15%, or 20% rate. You're going to be in whatever your highest bracket is, that marginal rate. Could be 22, 24, 32, up to 37.
And how does Social Security? Is Social Security a capital gain, or is that ordinary?
Social Security is also ordinary income, and you're taxed at the highest level is 85% of your Social Security is taxable. So it's not an 85% tax rate. You just say, oh, if I received $10,000 in Social Security benefits, 8,500 of it might be taxable income. It all depends. When you have very low AGI, then you
AGI stands for
adjusted gross income.
Okay.
Thank you. So if all your other sources of income are very low, you might be paying nothing on your Social Security. And then once your income rises above, we'll call it $25,000 to $32,000 above those levels, then it starts becoming 50% taxable, and eventually it becomes 85% of the benefit is taxable.
What I'm getting from this is that how you invest determines literally how you're taxed.
Correct. Right.
So a person who wants to lower their income tax rates should look at long-term capital gains. Can you spend long-term capital gains?
Once you realize them, once you sell the stock, then you can spend it.
So, and is that how you organize a person's portfolio so that they have long-term capital gains in that portfolio?
Absolutely. There's going to be ordinary income too. There's going to be some interest from bonds or maybe CDs and savings. So we're just going to look for the most efficient balance for the client. But a portion of it for sure, assuming they have the propensity to take a little bit of risk, a portion of it is going to be in stocks that are providing long-term capital gains and qualified dividends.
Can anyone professionally manage a portfolio without knowing your income tax rates or your income tax brackets and looking at an income tax return?
Not as a financial planner, you can't. If you're a pure investment person, I guess you could, but you still have to
not very efficiently.
Not efficiently. That's it.
No, that's
taxes are the most. It's one thing you can't find in a portfolio report. Oh, what was my rate of return for past 12 months, past 3 years, past 5 years? It never includes taxes in there, and I haven't figured out a way to do it. But one thing I can demonstrate on a year-by-year basis is if we do tax planning, we say, we do this, it's going to save you that much money. And people get it, but it never shows up in the portfolio report. It's a little bit frustrating, but
if you're not looking, if your advisor is not communicating with your CPA, you're doing yourself a real disservice. If you're investing yourself and don't take your income tax bracket in mind, you're doing a disservice. But understand the power of the long-term capital gain. Look at that. A married couple can earn $94,000 and pay zero in taxes. That is just absolutely astounding. And it's there. Partnerships. I hear so many partnerships. They'll give you great long-term return. What's from the tax point of view? Are they an issue?
Yeah, I'm not a big fan of these limited partnerships that are sold. Number one, they're very confusing. Number two, there are fees that you will never, ever, ever see. Layers and layers of firm fees from creating the partnership, attorney and accountant fees to put them together. And it all has to come from get paid by somebody. And it's not like the promoter is paying them. The promoter is going to recoup those dollars from somebody. And then on top of it, they're opaque. They are not clear. You can't find exactly what's going on inside of that company, and you have no control over it. Whereas a mutual fund, you can look and they'll tell you what the top 10 holdings are. If you want to know what every holding is, if it's holding 800 stocks, you can see the 800 stocks in there. If you go, I don't like it, you can sell it, and it's very cheap to sell it. A limited partnership, once you're in, getting out is very, very difficult.
Do mutual funds have to pay taxes?
The general rule is no, they don't pay taxes. They pass the income out to the shareholders, to the investors.
So you want a mutual fund that gives out long-term capital gains, not ordinary income.
Correct.
And so if a mutual fund churns or turns over their stock on a 4 or 5 times a year basis, are they maybe not the kind of tax efficient kind of mutual fund that you may not want to have.
Correct, because if they're going for short-term capital gains are taxed as ordinary income. So that's back to your highest tax bracket. You're not going to get this 0 or 15 or 20%. And these are very favorable. Let's say I'm a very high earner and my taxable income is over $500,000. I'm going to be paying generally 37% on my ordinary income, but my capital gains, I'm paying almost half that at 20%. So very favorable. And just for the, I'll say garden variety of America, most of us are in this realm paying 15%. If I'm in a 22, 24, 32% bracket, my capital gains at 15, I like that better than I do the higher brackets.
Yeah.
So yeah, we favor long-term capital gains.
Yeah. And somebody just mentioned or had the questions about ETFs, exchange traded funds. And we're going to get more into detail later on that. But just from a tax point of view, you have to look at inside the ETF or what's happening in within the ETF. It's an index fund. If they're doing a lot of trading, then it's short term. If it's an ETF that has index funds and don't do a lot of trading, it's more than likely going to put out long-term capital gains. But it's a great question because you need to know what kind of income it derives from your investment. What are the tax consequences? This is where the compensation that you pay to a financial advisor is worth its weight in gold. You want long-term capital gain. Let's go to the next slide.
Okay. Just by definition, long-term capital gains are you have to hold the asset 12 months or more, and the rate depends on your total income, not just the gain. So that's just some computational stuff, and I think it's kind of boring stuff. We'll move on to meatier stuff. Pete mentioned about annuities, but we'll go to even IRAs, 401k, 403b, 457. These are all typical retirement accounts, and they kick out ordinary income. So even if my IRA has a mutual fund in it, and if that mutual fund if it's paying out capital gain dividends, first of all, I don't have to pay any taxes on it until I pull money out of the IRA. So it can have capital gain dividends, doesn't affect me at all, doesn't affect the IRA. But whenever I want to pull money out, I don't get benefit of that capital gain. Everything I pull out of an IRA, 401k, et cetera, ends up being ordinary income. So as we age, now the required minimum distribution age is age 73, soon to move to 75. Used to be 70 and a half, that was the old rule. But those required distributions are going to be ordinary income to you. So you're forced to take it out. You're going to know it might push you up into a higher tax bracket and something to be managed. And then
But you need to know your tax bracket, okay? Don't just take out the minimum. Understand your tax bracket. If it's just a 2% increase, boy, that's pretty good.
Right.
Maybe take out more.
Right. Yeah.
It also has to do with asset location. In other words, you may want to have your high income, ordinary income investments in your IRA account. You may.
Right. And so I'll go back to what Pete was saying there. Let's say I'm going to go back. I want to buy a car sometime soon, and my required minimum distribution is $10,000. But if I have room to take $30,000 out and stay within my tax bracket, I may want to go in and go and take more than my required distribution. And the more you take out, it's going to lessen the future year's required distribution because you've lowered your IRA balance. That's just part of tax planning, tax management, we'll call that. We have a concept here called a qualified charitable distribution, and I know we're going to get a lot more into that later on in future programs, but this will avoid taxes on some or all of your RMD. If my RMD is $10,000, if I pull it out, it becomes taxable income to me. It increases my adjusted gross income, which is often not a good thing. Instead of doing that, I can take that $10,000, give it directly to a charity, to Laguna Canyon Foundation, to my church, synagogue, mosque. I can direct that to any charity I would like, and it's not taxable income to me. So it does not increase. I've satisfied my required distribution. I took it out, but I didn't have to pay taxes on it. So for those that are charitably inclined, it's a very, very good strategy.
By the way, who do you custody your assets through?
We custody our assets through Charles Schwab.
And what does that mean when I say who is your custodian?
What that means is it's an independent third party that's going to be sending out monthly statements to the client that we have no control over, which is a good thing because the clients can look at that custodial statement and see if something funny went on. Whereas if I'm the custodian, I can, like Bernie Madoff is the example, he can cook the books and say, this is what you have, whether you have it or not. But you have an independent third party telling you, and you can look at every single transaction. There's nothing we can do to change those numbers. The transactions are the transactions.
Yeah. And custodians like Schwab, Fidelity, Vanguard, and some others, they will let you know what your required minimum distribution is, usually at the end of the year. But you also can take out more than your required minimum at any time.
Yeah, and usually they'll notify you at the beginning of the year so that so that you know what you have to do. Normally you get some kind of a notification, and a lot of statements, I'm not sure if Schwab does. We used to be with TD Ameritrade, they merged. Not sure if that was the best thing in the world, less competition, but TD Ameritrade used to write on the statement every single month, would say, this is what your required distribution is. This is how much you've taken already this year.
Yeah, Schwab does not do that.
Okay.
Let's go. We talked a little bit about the Social Security. We talked a little bit about, Roth IRAs, greatest thing since sliced bread.
Absolutely.
But again, they're not taxable. What kind of assets you put in there is very important. Whether or not you want to transfer from a regular IRA to a Roth IRA, very personal decisions. You need to crunch the numbers. Let's go to the next slide.
Okay, and if we have time, we might talk about Roth IRA conversions, and if we don't, it'll be covered in future times too. So we're just looking at in terms of what the estate and gift tax exclusions are right now. Each person can give up to $18,000 per year to anyone they want to and not have to report that as a taxable gift. So if you have a grandparent with 10 children or 10 grandchildren, I'll say, they could give up to $180,000 out to their grandchildren and not have to file a gift tax return. And that's on per donor. So if you had a married couple, you can double that. Each one can give a grandchild $18,000. And you could see that happening, with, we'll say, if a kid's in college, a grandkid is in college and things like that.
People are so confused with that. They believe that if they give anything over 18,000, that they have to pay a tax on it. And that's not the case. If somebody gives $20,000 to the kid, what happens?
So if you give $20,000 to the kid, then you're supposed to file a gift tax return and say, I gave them $20,000. This $18,000 is exempt from so-called gift tax. And the extra $2,000, the next line down, this is lifetime, you can give away $13 million. It would just reduce that by $2,000. It would say, okay, you've used up part of your lifetime gift. So you have to file a gift tax return, but there's no gift tax to pay. So if you wanted to help a child or grandchild with a down payment on their home, let's say you gave them $218,000, you would say 18 is exempt from gift tax. I've now used 200,000 as a so-called taxable gift, and it's just going to reduce my lifetime. And if you're nowhere near this, if your estate is, let's say, $2 million, it's just not going to affect you at all. It'll never affect you.
And I would say 90% of people don't even file a gift tax return.
Correct. Yeah, even if they exceed it.
Yeah, even if they exceed it.
They don't. They should. They should.
Good. Okay. Exclusion to this is important if you're not a citizen. This is an important concept. Exclusion of gifts to non-citizens. Anything over $185,000, you need to kind of have a special trust. Please see a CPA.
Right. Because and the reason for this is that they're recognizing that, yes, you can give to a spouse, that is your spouse, but if they're a non-citizen, then they can take that money and take it overseas and nobody will ever pay estate taxes on it. So if you're very wealthy, you know, let's say you're above this $13 million and you're avoiding the estate tax regime, they want those dollars in the US because the foreign people should be treated the same as we are, and we don't want those dollars leaking out. Everybody should pay their fair share. So there's a limit. So, but it is fairly generous of what you can give a spouse on an annual basis.
Yes.
And then the tax rate, once you actually become have a taxable rate estate, it is 40%. So that's a very steep tax. And some people say, oh, if I'm worth $13 million, and let's say I'm worth $20 million, and I have, you know, between 6 and 7 million is going to be, you know, subject to estate tax. Some people go, oh, you know, if I had that money, it really wouldn't bother me. Until you go, okay, you got $6 million subject to tax times 40%. That sounds like $2.4 million. Would you like to write a check for $2.4 million? And people go, no, no one likes to write that check. And it doesn't matter. Even if it's $100,000, they don't like to write it, no matter how much money they have. So,
I think, go to the next slide.
Yeah.
And this is really important.
This is I alluded to it earlier at death.
By the way, do you before we go on to this, do you have a slide about the potential changes, or do you want to talk about a little bit about the
in estate tax?
Yeah.
Let's see if I do. Here are the estate tax changes.
Yeah, I think just important to keep in mind because 2026 is not that far away. Right.
So in 2018 is when there were both income and estate tax cuts. The estate tax cuts were super, super generous. It basically, the exclusion was doubled in 2018, and it's slated to expire in 2026.
January 1st, 2026.
January 1st, right. So you can think of it as December 31st, 2025 or January 1st of 2026, but that's when it's coming. And so currently we mentioned on the previous slide that the exclusion is 13.6 million per person, per spouse, I'll say. In 2025, we estimate it's going to be somewhere around $14 million
per person.
Per person. And then in 2026, it's going to drop to $7 million.
So if you're having a estate and you're single and you have about a $5 to $7 million estate, you may want to consider, you know, seeing a professional and seeing if there's anything you can do. Is this for certain that this is going to happen?
No, it's not. It all depends on Congress. So,
oh my God, depends on Congress.
It depends on Congress would have to change it. So we know how Congress, they, you know, the Democrats and Republicans, they agree on nothing. Yes. All they do is fight. There's no compromise. And so if they don't compromise, it will revert. They would have to come up with some sort of a compromise. And they've compromised in the past. In Obama's administration, it was slated to go, I believe, to $3 million. And somehow it got raised to $5 million through the negotiation process. They gave the Republicans that much, and the Democrats had to give something. I can't remember what it was, but it ended up increasing in sometime in the Obama administration, 2012, I believe it was.
Well, the point of the story is that nobody knows. Right. So, you know, don't make any permanent changes because no one really knows exactly what's going to happen. Right. Nobody has a crystal ball. And nobody can predict what Congress will do. Right. So, but you need to be aware of it. If nothing happens, this is going to be the rule. starting in 2026. Let's go back to step up in basis.
Okay, I'll make a comment first here that if your net worth, if you're truly high net worth, let's say $20 million, $15 million or more, that's when you may want to be taking some proactive
Good point.
Putting things in trust, stuff like that. You need to get sophisticated, but you need to start using this 13 million, because if 13 goes down to 7, your estate will be paying a whole lot more, and you can take advantage of the 13. So
there's plenty of techniques out there to avoid that tax.
Yeah, there are. So
step up in basis.
Step up in basis. So at death, assets received get a step up in basis to current value, as if you bought them as of the person's date of death. It reduces or eliminates capital gains for heirs. This applies to marketable securities, real estate, business holdings. What does it not apply to? Does not apply to IRAs, annuities, installment notes, and some other very specific assets. So if a person dies and you inherit an IRA, if you inherit an IRA, you're still going to be paying taxes on the distributions that come out of that IRA.
Same thing on the annuities.
Correct. Same thing on an installment note would be like if I had a commercial building and I sold it, but I carried the mortgage. I didn't get paid all in cash, but I'm getting paid over 10 years. If I die in year 3, as the payments come for the next 7 years, the capital gain that was in that associated with that note is going to be paid by whoever receives it.
So what I recommend highly is you take out a yellow pad or you talk to your bookkeeper or CPA and you say, gosh, list all your assets. What do you own? House. How do you have title to that house? What is your cost basis? What did you pay for it? Or if you own an apartment building, did you depreciate it? What is the cost basis where determines your tax if you were to sell it? So last thing is market value. What is the market value approximately today? You don't have to be precise. If you know that much about your own stuff, you are 90% better off than most individuals. So because in order to get the step up in basis, it depends on how you hold title to your assets. You want to talk about the community property rules?
Yeah, I'm looking at the clock. All of a sudden, we're bumping up on 11:30. So, but community property for a married couple, if you own property as community property, even if it's in a revocable living trust, when the first spouse dies, it gets a step up in basis. The surviving spouse can sell, downsize the home, pay 0 capital gains. So, if it's a person's separate property, and if I'm the survivor, my spouse dies, she dies, and I have a rental home that I inherited, I don't get a step up in basis on that unless I converted it to community property. So should we
title, it matters.
Should we open for some questions, or I'm not
sure.
Yeah,
we're gonna stop at exactly 11:30. So is there another slide that you want to talk about before we wrap it up?
Most of them are.
You know what? Briefly talk about Prop 19. I just saw the slide go by.
Okay. Yeah. So Prop 19, it kind of supplanted Prop 13. We still get the Prop 13. They can only increase our property tax by 2%. Wait, if I change title, put anybody else, whether I sell it or gift it, we're going to have a reassessment to fair market value. Unless, and so what are the exceptions? One is that you transfer to a spouse. That makes sense. I die, my wife gets the house. There's no reassessment on that. Transfer of only a personal residence to a child, and the child has to use it as their personal residence. If I have 4 children, only one can inherit that, and they got to move in. If you say, no, we're just going to keep it as a rental, boom, it's going to get reassessed. And what might have been a value for property taxes at $300,000 might be $1.5 million. You may be paying 5 or 6 times as much, and you're going to be dead, but the kids are going to be paying that much more, which gives them an incentive to sell it. So these transfers are difficult to do. There are ways of doing it. If you want to get a professional, where if you have commercial real estate, you could put it in an LLC and do some kind of fancy stuff and still avoid reassessment. But that's very, very detailed. You really need a professional to navigate that. So if you're thinking about any kind of transfers to kids, siblings, whatever else, you really want to avoid that reassessment.
By the way, that goes for any kind of a transfer, whether it's a house or, most individuals go up to their CPA and in, I'm going to say April, and say, well, I've reduced my taxes. Well, what did you do last year? I sold blah, blah, blah. Wow. You can't undo a sale. So find out the tax consequences prior to putting it on the market so that you understand it and see whether or not you can do anything about it. Mark, if we had an audience, they would give you a standing applause.
All 3 of them out there, huh?
Thank you so much. For those individuals who are watching, next week we're going to do Financial Planning 1. I think this is one of the more important sessions. You can download and print the workbook for the series. Use our online. There's lots of good articles on there as well.